Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. This video is all about tax-efficient bucketing of assets within your investment portfolios. In addition, we're going to compare today's analysis to some of the general guidance that can be found in JP Morgan's Guide to Retirement for 2025. Specifically for today's video, we're going to be considering the Evaluate a Roth at Different Life Stages section on page 19 of the guide. By the way, just looking at this chart from JP Morgan High Level, what does this chart remind you of? Well, it should remind you of our typical lifetime marginal tax rate profile right here that we were first looking at in Roth IRA conversion video series part 9 on YouTube. Before we get into the details, just take a look at the pattern right here. Your income and marginal tax rate typically increase over the employment or self-employment years. Then right here when you retire, your income and your marginal tax rate typically drop off for a period of time. And then your income and marginal tax rate begins to increase again as you get further into retirement. That's exactly the same thing we were talking about over here. You start generally with a lower income level, a lower marginal tax rate. That increases over the employment years and then drops off post-retirement, but pre-Social Security, pre-pension, and pre-RMD. This is the Roth IRA conversion sweet spot years right here. And that's the same thing that is being demonstrated graphically right here on this chart. Then as your Social Security and pensions and RMDs start to kick in, your income and your marginal tax rate will begin to increase again. Now looking more closely at this Roth IRA evaluation chart from JP Morgan, what is the general recommendation that is being made? Well, the first recommendation is to contribute to a Roth vehicle, i.e. an after-tax vehicle, during the portions of your life when your tax rate is lower. The second recommendation is to contribute to a traditional vehicle, i.e. a pre-tax vehicle, during those portions of your life when your tax rate is higher. And then right down here they note if wealth is concentrated in tax-deferred accounts like traditional IRAs or 401ks, which for many people it is, then one of the general recommendations is to consider proactive Roth conversions in those lower income years, or to be more specific, as we have talked about extensively on the channel, in your lower bracket years. You want to fill up those lower tax brackets in those Roth IRA conversion sweet spot years. But putting aside Roth conversions for the moment, what we want to talk about today is bucketing of different kinds of investments in different kinds of vehicles. For example, what are the best types of investments to bucket into your Roth vehicles? What are the best type of investments to bucket into your traditional pre-tax vehicles? We're also going to take it one step further in this video and compare the pre-tax vehicle to the after-tax vehicle as well as to the regular brokerage non-tax advantaged account. Now let me ask you a question. If you hold treasury bonds or corporate bonds or other types of taxable fixed income securities within your portfolio, what kind of income do those investments generate? And the answer is they generate ordinary income subject to your ordinary income tax rates. So if you have 3 buckets to choose from, and we're talking about the regular brokerage account or your taxable bucket, the traditional IRA or your tax-deferred bucket, and the Roth IRA or your tax-free bucket, which bucket would provide you with the greatest after-tax return on the fixed income portion of your portfolio? And the answer is it depends on your marginal tax rate now, and it depends on your marginal tax rate in the future. That is what's being said by JP Morgan right here in this chart. Contribute to a Roth vehicle when your annual taxable income is lower. What they really mean is when your marginal tax rate is lower. And then contribute to a traditional vehicle when your annual taxable income is higher, i.e. when your marginal tax rate is higher. So which vehicle will provide you with greater after-tax return over the course of your life? Well, it depends on your tax rate now, and it depends on your tax rate in the future. Let's do example 1, and here is my question for you before we get started. If you had to rank these 3 buckets in order from number 1 to number 3, with number 1 being the bucket that produces the largest after-tax return, and number 3 being the bucket that produces the smallest after-tax return, under the assumption that your marginal tax rate pre-retirement is going to be lower than your marginal tax rate post-retirement, how would you rank these 3 buckets? Make a mental note of what you think the ranking is, and let's hop into example 1. By the way, if you enjoy this video, please like and subscribe, and let me know in the comments what's going on in your personal tax planning situation. All right, so let's hop into example 1, and we are going to start with the traditional IRA, or our tax-deferred bucket. Now, every year on your tax return, Form 1040, you're going to have a variety of income. For this example, we're just going to use the amount of income that you would use to contribute to your IRA. So we're just going to say you have $7,000 of income here, and you take a deduction for $7,000 because, as you know, a traditional IRA contribution is a tax-deductible item. This is subject to various income thresholds, but for this example, let's just assume that those don't apply and you are able to deduct the full $7,000. So in this case, that results in taxable income of 0. The tax rate is 12%, leading to tax of 0. Also remember that for this first example, we are assuming that your marginal tax rate pre-retirement is going to be less than your marginal tax rate post-retirement. So for this example, your marginal tax rate pre-retirement is going to be 12%. Now, coming down here to the IRA growth calculation, we're going to start with a balance in the traditional IRA of 0 in this example. Because the tax on this $7,000 is deferred under the traditional IRA scenario, that leaves the full $7,000 available to make the annual contribution. So we're going to put $7,000 into the traditional IRA per year. Let's ignore the fact that the maximum traditional IRA contribution gets adjusted for inflation on an annual basis. Let's just keep the math simple at $7,000 per year. So now we have the balance after contribution is going to be the beginning balance, which was 0 in this case, plus the annual contribution, which is $7,000. That gives us a balance after the contribution of $7,000. We're going to use a modest 5% rate of return in this example. So the annual return on $7,000 at 5% is going to be $350. And then the balance at the end of the year will be the balance after contribution right here, plus the return, leading to $7,350. That $7,350 will carry over here to become the beginning balance for year 2. We have another $7,000 annual contribution, $7,350 beginning balance plus $7,000 is a balance after contribution of $14,350. A 5% return on that is $718. $14,350 plus $718 leads to an ending balance of $15,068 at the end of year 2. And that process is going to continue year after year, and we're going to go down for a full 20 years right here. And at the end of the 20th year following this methodology, the balance in the traditional IRA is $243,035. Now, the final part of the calculation here to figure out the after-tax value is to take the balance pre-tax, which was the $243,035. We're going to assume for this example that your tax rate in retirement is 24%. As I said, the assumption in the first example here is that your tax rate pre-retirement was lower than your tax rate in retirement. So a pre-tax value of $243,045, you pay 24% tax on that over time. Just to be clear, we're not saying that the full balance of the traditional IRA is being distributed in total in 1 year. We're simply saying that over time, during retirement, when you take distributions from your traditional IRA, whether they are in the form of RMDs or just regular distributions, they will be subject to a 24% tax rate during your retirement years. Therefore, the total tax paid on all of the distributions combined over the years will be $58,328. That is simply the $243,035 multiplied by 24%. And that leaves an after-tax value here in this scenario of $184,706. And that amount is calculated simply by taking this $243,035 and subtracting off the amount of tax right here. So to summarize, in this fact pattern with a $7,000 annual traditional IRA contribution and with a 5% rate of return over a 20-year investment horizon, assuming that your tax rate pre-retirement is 12% and your tax rate post-retirement is 24%, the after-tax value of the traditional IRA is $184,706. Okay, now let's move to the Roth IRA or the tax-free bucket. Now, before we work through the numbers, what is your expectation of the results here? Remember, in this fact pattern, the marginal tax rate pre-retirement, we are assuming, is lower than the marginal tax rate in retirement. So is your expectation that the Roth IRA will produce a larger after-tax value than the traditional IRA? Or is your expectation that the Roth IRA will produce a smaller after-tax value than the traditional IRA? Well, let's work through the numbers and see what we get. So this time on our 1040 tax return, we have the same amount of income, $7,000, but there is no tax deduction related to a contribution for a Roth IRA. So that leads to taxable income of $7,000. The marginal tax rate, as we have said, is 12%, and that results in tax in this example of $840. Now, in the Roth example, we have to take things one step further because we have just paid $840 in tax. So we don't have the full $7,000 left to contribute to the Roth IRA in this example. So we're going to take our income right here of $7,000. We're going to subtract off the cash tax paid of $840, leaving after-tax cash available for investment of $6,160. And that is the amount we're going to use for the annual contribution in the Roth IRA example. Remember, we want to keep these two scenarios right here between the Roth IRA and the traditional IRA comparable. So even though I understand you can contribute, let's say, up to the maximum of $7,000 in the Roth IRA, doing so would require you to pay this $840 with outside funds, and therefore the examples would not be equally comparable. We're just going to say there's $7,000 here total to work with per year. Over here in the traditional IRA example, none of it goes to tax up front because it's all tax deferred. In the Roth IRA example, $840 of it goes to tax each year, and that is why there's only $6,160 left. So everything else is going to work the same way. $0 beginning balance for year one. There's our annual contribution of $6,160. Balance after the contribution in the first year is $6,160. 5% rate of return on that balance after contribution is $308. And then balance after contribution plus the return for the year leads to an ending balance of $6,468. That ending balance of $6,468 carries up to the beginning of the next year. And then everything else works the same mathematically, just like we went over in this calculation. So we will continue to have our equivalent annual contribution, we will continue to have our 5% return, and we will go out for 20 years. At the end of the 20-year period under this fact pattern, The balance in the Roth IRA is $213,871. So going down here to the final step, we take the balance of $213,871. There is zero tax on distributions from a Roth IRA. So there is no tax due on this money. There is no exit tax when you take the money out of the Roth IRA vehicle. And thus the after-tax value of the Roth IRA in this fact pattern is $213,871. So let's just compare those two results. We had $184,706 in the traditional IRA. We have $213,871 in the Roth IRA. That is a pretty significant difference. And so the takeaway that we have so far is when we're considering tax-efficient bucketing of assets, the Roth IRA is going to produce a significantly larger after-tax value versus the traditional IRA in a fact pattern where your marginal tax rate is lower pre-retirement than it is post-retirement. Now let's go over here to the final part of example 1, which is the regular brokerage or taxable bucket. Thinking back for a moment, here was the traditional IRA result. Here is the Roth IRA result. What do you think is going to happen in the regular brokerage account? What is your expectation? Is the after-tax result going to be larger than both of these? Will it be smaller than both of these, or will it be somewhere in the middle? Well, let's run through the numbers. So from a tax return perspective each year, this is going to be identical to the Roth IRA situation. There is no deduction to make a contribution to a regular brokerage account, so this number is going to be 0. That leads to taxable income of $7,000. We have the same marginal tax rate of 12% and the same amount of tax, $840. And this after-tax calculation right here is the same. We have $6,160 to invest each year in the regular brokerage. Now down here, this is going to work the same way as we just went through with one exception. So we start with a 0 balance. That is the same. We have our annual contribution of $6,160. That is the same as the Roth. Our balance after the contribution is $6,160 for the first year. There is our $308 from the 5% rate of return. Now the one item that is new right here is we're going to have to pay tax on an annual basis on the amount of return. So basically we're going to have to pay tax at 12% on the number in this column right here. So right here, 12% of a $308 return is $37 of tax. And therefore the ending balance right here will consist of the balance after the contribution plus the return minus the tax that was paid on that return. And then of course the $6,431 will carry to the balance at the beginning of the subsequent year, and then everything else will proceed in the same manner just as before. We will still go out here for the full 20 years, and the result in the regular brokerage account at the end of the 20-year period is $199,651. Okay, the final step here is we take the balance of the $199,651. There's not going to be any tax on the distribution of this money because we are assuming this is fixed income. We are holding to maturity. We're putting aside any capital gain that may or may not be realized from trading fixed income investments. We are simply looking at the interest income or the ordinary income on these items. So since we paid tax on that income right here all along the way every year, there is no tax left to be paid at the end of the 20-year period. Therefore, the after-tax value is $199,651. Okay, so let's compare the final results in an environment where your marginal tax rate is lower pre-retirement than post-retirement. Or let's get even more specific. When your marginal tax rate is lower during the contribution years and higher during the distribution years, whether those distributions are RMDs or regular distributions or whatever, then in that situation, the traditional IRA over here is going to produce the worst after-tax results for your family. The Roth IRA will produce the best results, and the regular brokerage brokerage account will produce something in the middle. Now, why is that? What is the reason that we can point to why these results are so dramatically different? Well, in the traditional IRA situation, we are deferring tax on the principal or basis. The principal or basis I'm going to refer to as the sum of these annual contributions. So we're deferring tax at 12%, but then ultimately we are paying tax on both the principal or basis as well as all of the earnings over the 20-year period at a 24% rate. So when you defer at 12% but then ultimately pay at 24%, you're going to get worse after-tax results. Over here in the regular brokerage situation, we are paying tax on the principal or basis upfront at 12%. We are paying tax over time on the earnings at 12%. And so all of the tax on both the principal or basis as well as the earnings has been paid at 12% in this example over here. And so 12% is obviously lower than 24%, and therefore this after-tax result is going to be bigger than the traditional IRA. Finally, in the Roth IRA situation, we are paying tax on the principal or basis upfront at 12%, but then we are not paying any tax on the earnings at all, not throughout the 20-year period and also not at the end of the 20-year period. So the earnings in this example are basically taxed at zero. Therefore, if you have the principal or basis taxed at 12% and the earnings taxed at zero, that is the reason why the after-tax value in this situation in the Roth IRA is going to be the largest. So the takeaway from example 1 that I want to use to compare to these two charts right here is that the Roth vehicle is the most beneficial in two circumstances. The first one is when your marginal tax rate is lower in the contribution years than it is in the distribution years. And the second one is when your marginal tax rate is lower in the conversion years than it was in the contribution years. Let me say that part again, and we're going to look at that in example 2. If your marginal tax rate in the contribution years is higher, you probably will want to be using the traditional vehicle. But then when you get out here to the conversion years and your marginal tax rate is lower, that is how you get the money that you deferred at a higher marginal rate taxed at a lower marginal rate. And that's what the Roth IRA conversion sweet spot is all about. Most Americans will have some period of time right here that is pre-Social Security, pre-pension, pre-RMD, but also post-employment. And they will have substantially lower marginal tax rates for a number of years relative to what their marginal tax rates were back here. So if you're deferring into the traditional vehicle at the higher rates and you have these lower rates available, that's when the Roth IRA conversion is the most beneficial. Now for example 2, I want to switch things around. Let's say that your marginal tax rate pre-retirement is higher than your marginal tax rate in retirement. If we assume that situation, then let's go see what the after-tax results are between the traditional Roth and regular brokerage, and we can compare them to the results in example 1. Okay, here we are in example 2. Let's start with the traditional IRA or tax-deferred bucket. Now, from a tax return perspective, everything looks basically the same except for the fact that we are assuming now a 24% tax rate pre-retirement. And so this example is going to be the reverse. We are now deferring at 24%, and then we will assume that our tax rate in retirement is going to be lower at 12%. So let's see what the results are there. For the traditional IRA, everything down here showing the return on investment is going to be the same as the previous example. We're going to do a $7,000 annual contribution. We have a 5% rate of return. The process for calculating this over the 20-year period is the same as we went over before. So scrolling down to the bottom here, we have a balance at the end of the 20-year period of $243,035. As I said, we're assuming a lower tax rate in retirement of 12% into perpetuity. 243,035 times 12% leads to 29,164 of tax on the distributions over time. And therefore the after-tax value is the 243,035 less 29,164 of tax, resulting in 213,871. Now right here in the Roth IRA or tax-free bucket, everything about the tax return calculation here is going to be the same except for the fact that we now have a 24% marginal tax rate pre-retirement. So $7,000 of taxable income at 24% is going to be tax of $1,680 each year. And then over here in the after-tax calculation, we take our $7,000 of income, we subtract off the $1,680 of annual tax, and so that leaves us only $5,320 of cash available for investment, and that is the amount we're going to use right here for our annual contribution to the Roth IRA. So again, exactly the same process here to calculate the rate of return over 20 years. We're going to go down to the final part of the calculation. The balance in the Roth IRA at the end of 20 years is $184,706. There is, of course, zero tax on that since it is a Roth IRA, and therefore the after-tax value is $184,706. So comparing just the results that we have so far in example 2, $184,706 in the Roth versus $213,871 in the traditional, you can see that if your tax rate is higher pre-retirement, or more specifically, if your tax rate is higher in the contribution years, and then your marginal tax rate is lower in the distribution years, you can see that the traditional IRA will produce a substantially better after-tax return than the Roth IRA. And so what you should be starting to see is that when you're making the decision about what assets to bucket into what investment vehicles, meaning do you want your fixed income to be more heavily concentrated in Roth or in traditional or in regular brokerage? And the same question will be applicable to your tax-free interest income from muni bonds down here. We're also going to look at long-term capital gain and short-term capital gain. You should be seeing that depending on which vehicle you choose to bucket various kinds of income-generating assets in, you can wind up with substantially different results, and much of it has to do with your marginal tax rate analysis. Now we're going to go take a quick look over here in this section at the regular brokerage. What is your expectation? Is the amount going to be between these two just like it was before? Or is it going to be greater than this one? Or is it going to be less than this one? Let's go check it out. Okay, here we are in the regular brokerage account. So the tax return calculation right here, as well as the after-tax cash calculation for the amount we have available to invest, that is going to be the same as we just went over right here with the Roth IRA. The rest of this down here is going to work the same way. We have our $5,320 of annual contribution. We also have our tax this time at 24% because that is the rate we are assuming pre-retirement. So 24% of the first year's 5% return of $266 equals $64 in tax, and the process continues just like before. All right, going down here to the final results, the amount in the regular brokerage at the end of the 20-year period is $161,068. Again, there is no tax on the exit right here because we're assuming no capital gain. We're just looking at the income portion of this investment. So our after-tax value is $161,068, substantially lower than both of these over here this time. So the takeaway from example 2 is that when you have a higher tax rate in your pre-retirement years, or more specifically a higher tax rate in your contribution years versus your distribution years, then the traditional IRA is going to outperform as an investment vehicle versus the Roth IRA, and then then versus the regular brokerage. By the way, where in example 2 did we see the Roth conversion opportunity? And the answer was in the tax rates. We assumed a 24% tax rate over here in the pre-retirement years, and then we assumed a lower 12% rate in the post-employment years. Now in example 2, just for mathematical simplicity, we left the 12% into perpetuity, but in practice we know that the opportunity for those lower rates is going to be concentrated in here in the Roth IRA conversion sweet spot. But the point is that is what we are looking for with respect to Roth conversions, a higher tax rate in the earning years, followed by some period of time in the retirement years in the Roth conversion sweet spot where the marginal rate is lower. All right, now let's move to example 3. So this time, instead of fixed income instruments that produce taxable ordinary income, we're going to take a look at muni bonds. These produce income that is tax exempt for federal income tax purposes. So if we go up here to the tax return calculation for the traditional, this is going to be the same. We have income of $7,000, but this item is not taxable in the first place for federal. So that $7,000 is basically going to be excluded from the return. That is the interest on muni bonds. The exact same thing is going to be true over here in the Roth, and the exact same thing is going to be true over here in the regular brokerage. So in example 3, we're going to be able to start out with an annual contribution of $7,000 here, $7,000 here, as well as $7,000 over here. There is no upfront amount of tax due each year on this particular kind of income. So for purposes of the rate of return calculation, just like before, everything is working the same way here, everything is working the same way over here in the Roth, and everything is working the same way over here in the regular brokerage, with the one exception being that when you're holding these municipal bonds, the income is not subject to tax, as we just said, so the annual tax cost right here is going to be 0 in this case. Okay, now scrolling down here to the final results, the traditional IRA has a balance of $243,035 at the end of the 20-year period. We are subject to the exit tax from the traditional IRA vehicle, so we've been using 24% so far in this particular example. That leads to tax over time on the distributions of $58,328, and it results in an after-tax value of $184,706. Now the Roth IRA right here, as well as the regular brokerage account, both have the same value at the end of the 20 years. In fact, all of them have the same value, $243,035 in this example. However, there is 0 exit tax on the Roth IRA, as you know, so the after-tax value this time is $243,035. There is also no exit tax over here on the regular brokerage. All the tax has been paid all along the way right here, except for the fact that this particular kind of income was subject to 0%. So there actually was no tax all along the way, and we have an after-tax result of $243,045 here as well. So clearly the takeaway here is that the traditional IRA is going to be your worst performing vehicle in the case of tax-free interest income. The Roth IRA and the traditional brokerage will perform the same, but generally, because the amount of funds that you can get into a Roth IRA is limited relative to the amount you can put into a regular brokerage, bucketing tax-free interest income into the Roth IRA probably is not going to make sense when you can get the same result over here in the regular brokerage. Okay, example number 4, long-term capital gain. So let's say that your intention is to hold some investments for the long haul, and your purpose in holding these investments is not so much the annual income generated generation like interest and dividends, but what you're looking for here is market appreciation over time. So for that kind of investment that will generate a long-term capital gain, what is the best vehicle within which to hold such investments? Let's start right here with the traditional IRA. Let's assume that your tax rate is lower in the pre-retirement contribution years again. So we have a 12% tax rate up front. We are deferring tax at 12% for purposes of putting the money into the traditional. Over here in the Roth, as you know, we don't get any upfront deferral, so we're paying tax at 12%. That's $840 of tax, and we have after-tax cash available for investment of $6,160. This fact pattern right here is the same thing that we had in example 1. Coming over here to the regular brokerage or taxable bucket, the situation with the tax return as well as the after-tax cash available for investment will be the same as what's happening over here in the Roth IRA. So now going down here to the final results, these numbers should look familiar. $243,035 is the value in the traditional IRA. We have the 24% exit tax right here, so we have after-tax value of $184,706. In the Roth IRA, we have $213,871, zero tax, so the after-tax value remains at $213,871. And then finally over here in the regular brokerage, we have $213,871 less our basis. Now, what is that number right here? Well, if I double click on that, you're going to see it is the sum of all of the contributions that we made to the account. We were taxed on that money up front here in the tax return before each contribution was made, so we don't have to pay tax on that again. That is our cost basis, so we're going to take that part out, leaving capital gain of $90,671. We have our capital gain rate of 15%, leading to tax of $13,601. So if we take our balance of $213,871 and we subtract off this $13,000 of tax, that results in after-tax value of $200,270. One more thing to note right here, the reason I have 0% is because remember in this fact pattern we are holding for long-term appreciation. Therefore, we have no annual transactions that are subject to any tax. So if we compare the results down here, the Roth IRA is the best performer for long-term holding in this example. The regular brokerage account is the second best performer, and the traditional IRA is going to be the worst performer. Now remember, this is a situation where our marginal tax rate in the contribution years is assumed to be lower than our marginal tax rate in the distribution years. So again, think about this. We deferred tax on the principal or basis at 12%, but we're ultimately paying tax on the principal or basis as well as the earnings at 24%. In the Roth situation, we paid tax upfront on the principal or basis at 12%. So the principal or basis avoids the extra 12% that is occurring over here in the traditional, and the earnings in the Roth avoid the full 24% rate. In the regular brokerage, we pay tax at 12% upfront on the basis or principal, and then we pay at 15% on the gain at the end. So the principal over here is only getting taxed at 12% versus 24% in the traditional IRA, and the gain is getting taxed at 15% over here versus 24% over here in the traditional IRA. The interesting takeaway from this example is that if you are going to hold long-term anyway, meaning you have a particular bucket of investments or assets that you intend not to liquidate anytime soon, it is certainly possible, depending on your marginal tax rate over time, that you will achieve a much better result holding those long-term investments in just a regular brokerage account as opposed to holding them in a traditional IRA. By the way, for anyone who might be confused about the long-term capital gain rate and how it applies over here, remember that it doesn't apply. Once you put money into any tax-advantaged vehicle, you don't get the benefit benefit of the preferential long-term capital gain rate anymore. Anything that happens inside the IRA vehicle is subject to ordinary income tax, and therefore subject to your ordinary income tax or marginal rate. I've said this before on the channel, and this is the reason right here why Warren Buffett says that he pays a lower tax rate than his secretary. And that is because most Americans will put long-term holdings into their traditional IRA, and they lose the benefit of those preferential capital gain rates. They end up paying 24% or whatever their marginal tax rate is on those capital gains. Whereas Buffett over here doesn't have money in traditional IRAs. His long-term capital gains are subject to the 15 or 20% rate. So when it comes to bucketing your assets, you might want to seriously take a look at the possibility that you are getting dinged effectively by holding long-term over here when you could be holding long-term over here. Assuming you're going to hold long-term anyway, you might want to bucket more of those long-term capital gain assets over here in the regular brokerage. Okay, example number 5, short-term capital gain. So this is going to be your day trading, your swing trading, your active portfolios. Starting up here with the traditional IRA, this tax return is going to look the same as it always does. We're going to assume a 24% tax rate in the contribution years. And over here in the Roth IRA, as well as the regular brokerage, all of this should look familiar. We are paying tax at the 24% rate up front in both cases. We have $5,320 to invest on an annual basis in both cases. Now back over here in the traditional IRA, as well as the Roth IRA, you can have as much trading activity, you can have as much short-term capital gain as you want. There is no annual tax impact to having those transactions. The only difference right now is the starting point, $7,000 annual contribution in the traditional, $5,320 in the Roth. Over here in the regular brokerage, we start with the same $5,320. We do have to pay tax on an annual basis at our marginal rate right here on all of the short-term activity that we're saying we have in this example. So this column will be populated with the annual tax on the amount of return that is right here. Now going down here to the results and assuming a lower tax rate in retirement than in the pre-retirement years, we have 243,035 balance in the traditional, 29,164 of tax at 12%, leaving an after-tax value of 213,871. Now going over here to the Roth, we have 184,706. As we know, there's no tax on that, so our after-tax value is 184,706. And then finally over here in the regular brokerage account, we have a balance of 161,068. There is no exit tax because we have only short-term capital gain and the tax on that has been paid on an annual basis. So that leaves us with 161,068 in the regular brokerage. Now think about those results for a minute. Where do people typically engage in short to mid-term trading activity? Where do they usually keep their active portfolios? Well, often people tend to keep them in regular brokerage accounts. At the same time, where do people typically not keep their active portfolios? And that would be in their IRAs. But you can see right here, based on the results of the traditional as well as the Roth, because those IRA vehicles give you the advantage of not having those short-term capital gains taxed on an annual basis, you have the potential to end up with a much larger after-tax value if your active portfolios are actually over here in the tax-advantaged accounts, and you may end up with much less if your active portfolios are over here in the regular brokerage account. Ironically, we saw on the previous slide that was reversed for long-term capital gain. You had more opportunity over here in many cases, and you had less opportunity over here. When you actually lay out the numbers and see that, you realize that a lot of people are doing the reverse. They have all of their long-term stuff over here here in the IRAs. They have their short-term stuff over here in the regular brokerage. And when you lay out your own numbers and you take a look at what the results could be, you may see that bucketing your assets in that manner may lead to much less favorable after-tax results versus what you could achieve if you rebalanced your portfolios to have more activity over here and less activity over there. By the way, if you want to analyze your own portfolios to see how they stack up on an after-tax basis, both as currently weighted and as potentially reweighted to gain more tax efficiency within your overall investment strategy, my investment optimizer calculator can be used to model out your portfolio weightings by incorporating both your projected investment return on various strategies as well as your effective income tax rates on that projected return. By using the investment optimizer calculator, you can begin to refine your bucketing of assets between your pre-tax accounts, your after-tax accounts, and your fully taxable brokerage accounts. If you are interested in learning more about that, make sure to check out my Roth IRA conversion video series on YouTube. You can find the link to video 1 of that series in the description below this video, or just search on YouTube for Number Crunch Nerds Roth IRA conversions. Alright, that is going to be it for today. I hope you enjoyed today's video. Thanks for watching, and I will see you next time.